Good evening, guys. Welcome to this week's forum. As always, we'll give attendees about 30 seconds to stream in. And while we're doing so, I'm going to briefly run you guys through our standard disclaimer. So first of all, the weekly forum is strictly for our subscribers. It is meant purely for informational purposes. It's not meant to be investment advice. It is the opinion of our insight providers and not that of anyone at Smartkarma. And lastly, but quite importantly, Chatham House rule applies. So please do not share any of this information on social media or any other public avenue without express permission. And with that in mind, let's take a very quick recap of the last few forums. As I was mentioning last week, this is something we want to do regularly on a weekly basis, just to refresh our memories on what we discussed. So last week, we took a quick look at the Greater Bay Area theme, how that's becoming a major driver of change within the sort of Hong Kong, Guangdong area, and how Shenzhen International, which is 152 Hong Kong, is going to emerge as the leading proxy for that region, much like Swire was for Hong Kong back in the day. As it stands, this remains an under-discovered and under-researched stock, something we quite like. Second, we also spoke about Wilmar. We spoke about the potential for this name to double on the back of the valuation that's been crystallized from the listing of a subsidiary on the Chinese market. And third, we examined the case to be going even more bullish and positive on the global banks. And we saw, some very strong earnings coming out from that sector in the days after. Once again, all of these links, slides, recordings are available. If you guys want to access any of them, drop us a message at plus@smartkarma.com and we will get back to you. Now, this week, there's three things that we're looking at. First of all, we're going to look at a stock that would be termed as a dog, because the stock hasn't done very much at all in a very, very long time, but we think that it's about to have its day. Secondly, we wanted to focus and draw your attention again on PC Partner, just a reminder of something that's around the corner. And finally, and quite against the grain of the markets, we wanted to discuss a potential warning for the year. Before I begin, just a couple of other things. You can ask me questions at any point of time. You can just use the Q&A button or even just sort of chat. The forum is meant to be informal. It's meant to be conversational. It's meant to be two-way. It's meant to be also rapid fire and open mic. So we're not going to get into too much detail. We're going to keep it short and sweet. So let's look at the first idea. China Communication Construction 1800 Hong Kong is a large cap that has, as you can see from this chart, been in a downward trend for over 3 years now, hence the label dog. However, there are several reasons around why our analyst, in this case, Oscar Tang, thinks that this name is likely to reverse. Before we get into that, just a couple of things. This is an $8 billion market cap company. It trades $26 million a day. You can see that on most valuation metrics, it's extremely cheap. For example, it's just on 0.2 times price to book. The particular insight that I would like you to pay attention to, there's actually two now. The first one was all the way back in early January, China Communication Construction Brewing Bull. And the other one was positive takeaways from a call with the company. So let's look at some of the reasons that Osbert found to be bullish. This company, as the name alludes, it's in the construction business, it's in the toll roads business, and it's a Chinese company. Historically, it used to do a little bit of international business, but over the last few years, most of the business is now concentrated in the domestic market. Over the last few years, we've seen volatility in order flow, but ever since early last year, when the Chinese government started injecting liquidity, especially towards the infrastructure sector, we're seeing a rapid growth in construction order flow from local municipalities, and that benefits these companies. There has been some worry recently around some Chinese stocks and US executive orders. However, that does not impact the stock. Thirdly, this company operates a bunch of toll roads, and the toll road concession business has been recovering very nicely post the COVID break. That's something we've covered in previous forums, how toll roads are actually very, very defensive, but great ways to play the recovery. Now, this stock dropped pretty sharply around the end of last year because of certain changes in the MSCI index composition, where it was deleted or removed from some of these indices, which caused passive funds to just bin the stock. However, the company is doing quite the opposite. First of all, they're progressing very well on plans to list a REIT. Again, this has been a theme we've spoken about quite repeatedly because it's a very differentiated theme. This company will look to spin off its toll roads into an infrastructure REIT and list it on the mainland Chinese A-share market. Also, the management is actively exploring the buyback of its Hong Kong listed shares because they're trading very, very cheap relative to their A-share listing. And given you're trading on a price to book multiple of just 0.2 times, there is significant headroom for the stock to re-rate. And just, I think for me personally, I really like the fact that Osbert spoke directly with the management of the company and got their perspective. And let's briefly skim through this. This note came out, of course, about a week ago on the 13th. So, new contract outlook. This is what we were talking about earlier. And what he is summarizing here is that construction pipeline, environmental facilities, a lot of these municipal local projects are doing quite well for them. They're not impacted by US tensions. Yes, they have quite a bit of debt, but also explains why the stock has been falling, which is precisely why they want to list this REIT, which will unlock that value for them. Okay, and I think this particular catalyst, the REIT issuance, is really, really ignored by the market right now. Also, I think when you talk about these government-linked companies in China, changes in management are quite important. So the company's had a new president who came on board in October, and his main focus is to move profitability, and he's been incentivized as much. And on capital management, this is also very interesting. The management is increasingly focusing on buybacks and other means to revive the share price. So what's been the impact since Osbert started sort of focusing on this name? So let's look at just the 3 months. So this is when he's really started talking about it. You can see, we've had a little bit of movement in the name, but it's nothing really. We're still very close to that 0.2 times book threshold. And hence, this is a nice large cap to be paying a bit of attention to. I'm gonna pause here momentarily in case you have any questions. Again, as I mentioned, you can ask questions at any point of time, but certainly towards the end as well. Okay, so there's a question that's come in from one of the attendees here in Singapore. They're asking about cash and liquidity for the company. So actually, if we go into the working capital here and look at the last 10 years, so their cash conversion cycle's actually been very, very stable. So there isn't so much of a working capital or cash constraint. But yes, if you do look at their leverage levels, again, they're stable, but they're not low numbers. You're looking at a 0.8 times net debt to equity. Now, let's put that into perspective. This is a state-owned enterprise. These companies tend to be highly leveraged, and they tend to get very good access to funding from the local and state banks. So we don't see huge causes for concern, but we do like the fact that the thesis for the next 12 months is all about bringing leverage down and bringing margins up. And that's clearly not being reflected in the current price multiples. Great, good question. Let's move on to the next thing. PC Partner. We've spoken about this name before, and when we look at some of these smaller caps, we're looking for two things. One is we're looking for some clear catalysts where we really want to make sure that we're not stuck in a small name for a very long period of time. Secondly, what we're looking at also is management, quality of management, and access to management. And it was the confluence of those reasons that led to us picking up on PC Partner. This was, as I think we had labeled, a hidden play on the revival of crypto mining, but that was not the only driver for the name. It was a stock that was about to reverse the decline of the last few years, get back into profitability, become a net cash balance sheet, give a very large dividend, and so forth. So why the reminder? So the reminder is because Nick, who's the analyst here, he's done a bunch more work, and he's banging the table that according to him, this company should be reporting a positive profit alert before Chinese New Year. So that's just in the next 2-3 weeks. That's a nice short-term catalyst. Secondly, its underlying customers, NVIDIA, AMD, all of these guys are really in a bit of a super cycle at the moment. And this is a poor man's NVIDIA. It's a proxy to that exposure. By the end of this year, the company would be in a net cash position. And as such, they're going to start paying a dividend this year, and it'll look very cheap on a yield perspective. And also historically, I mean, this thing traded up to about $7. And its valuation is not expensive in the context of the earnings rebound. So that's why a reminder. As you can see, Nick has recently, I think that was just yesterday, put out an update where he has revised his fair value on the company to $4.50. The stock had a very good day today, 8.5%, and I think it's only Smartkarma that has research on this company. None of the other banks or brokers cover this stock. So again, a very under-owned and really not a discovered name that's about to enter a cyclically very positive period. Any questions on this, guys? I think this is something that you would be familiar by now if you've been attending the previous forums. So I'm going to skip right through to the last part of today's discussion, which is a warning. Now, this is quite interesting. First of all, I want to talk about liquidity, and I want to talk about why a lot of liquidity can be a dangerous thing. And before I do that, I want to introduce you to Michael Howell. Michael is a liquidity strategist. In fact, he has a PhD in liquidity. He used to be at Solomon Brothers all the way from 86 to 92. Then he was the head of research for Baring, and he's been for the last many years managing director at Cross Border Capital. He's based in London, and he focuses on how liquidity drives markets, different markets. And that's a very unique and interesting framework, which gives a very good perspective into when you should be buying or selling markets at large. And he's been extremely bullish on the markets pretty much since March of last year when he saw central banks injecting that liquidity. And I think his stance is starting to change a little bit, marginally, and that's what we want to talk about. Before I get there, I just want to show you, what is happening to global liquidity as a percentage of world GDP. So you can see that, for much of the 2000s, we were in a bit of a plateau. It was fairly stable, maybe going up a little bit. But in the last 2-3 years, I mean, this has been an explosion. I think we've added more net new liquidity to the system in the last 3 years than we did over the last decade. And that's interesting. The net result of this is that this year we will definitely see a sharp rebound in real economies. So last year we saw stock markets move very, very rapidly, very sharply. People are still sort of enjoying the rally in markets. But now the real economies are going to catch up. And what I mean by that is the GDP prints that you're going to see coming out of China and India and ASEAN economies and the world really are going to be very, very strong and much better than people expect. Case in point is you probably saw China report 6% plus number just a few days ago. And analysts are now saying the next few prints are going to be 8% plus. So these real economies are now rebounding very, very sharply. GDP growth is accelerating. And from a liquidity strategist viewpoint, strong economies do not translate into strong financial markets. So what this means is the sizzle of the first half of this year is going to fizzle out. And the reason it's going to fizzle out is because the strong liquidity will lead to a very strong rebound in GDP, which will lead to a dramatic change, dramatic from the context of 0% interest rates, but a significant change in the stance of monetary policy makers around the world. And that will result in a very, very different outlook for asset markets into the second half. So it's something to be really aware of. Just like last year was, a year of two halves, right? Or maybe a quarter and three quarters. I think this year will certainly be a tale of two halves, where the second half might look very, very different from the first half. Now, having said that, Michael does not see any evidence of a bubble when it comes to valuations or conditions. And this is really interesting because we look at the S&P where it is, we look at a lot of markets trading on multi-year highs and we go, hey, our market's in bubble territory. But the real way to look at these things is a bit different. You have to look at, and this is where he talks about, is it the greatest bubble or not? So this gets a tiny bit technical, but really what you want to look at is where is liquidity and where are valuations in the context of that liquidity? When there is more money around, certainly asset values have more room to go up and vice versa. So you can't just look at what the PE ratios are today and say the market is expensive. You have to put that in the context of the liquidity in the market. And that's what Michael does. And that's why he's so differentiated and so useful to follow. So I think for those amongst you who want a very good steer on the direction of policy or regulation or markets, Michael's someone you should be following. With that, I think we're sort of done for today. But if you have any further questions, please let me know. It doesn't have to be necessarily questions on what we've discussed or described today, but perhaps even any of the ideas from the previous few weeks that you might have been following closely. Okay, great. Thank you very much for participating today, and we will catch up again next Thursday. Thank you very much. Bye-bye.